Happy Independence Day markets! With 288,000 new US jobs, economist and Fed watcher Ulrike Rondorf joins me down the line just now to discuss. Ulrike, this is a pretty clean number, a trifecta of good news perhaps, with the trade balance beating expectations also. So, can the 4th of July celebrations start early?
So this labour market report certainly gives the Americans another reason to celebrate tomorrow. But looking at the details, maybe the sky is not as blue as the headlines suggest. So, of course, the unemployment rate declined and the job growth seems to be more solid than expected. But if you look at the participation rate and also the involuntary part-time employees, these figures are not so, have not improved this month, and this will certainly also have an impact on the Fed looking at the labour market, and there are still some details which will not please Yellen.
There is the other argument that the economy is simply growing from a slow base. The housing market and real wages, among others, still causing problems. Are these real or manageable dangers?
Of course, the housing market is still one of the major worries of economists and also of the central bank. And here we expect growth to remain sluggish for the coming quarters, mainly due to the fact that we are still rarely have recovered from the bubble, and also interest rates are expected to increase. So, of course, this will dampen the housing market. On the other side, we have a lot of positive data coming from the manufacturing sector, looking also at the investment activity and also looking at the latest retail sales, etc. These argues you for strong growth from these sectors. And so the housing market will dampen growth, yes, but the other sectors are strong enough to make up for that. So we expect that after this weak start to the year we have seen over in the US, that growth will improve notably over the coming quarters.
Good news as it is, traders and analysts said a strong employment report Thursday likely raises anxiety over whether the Fed may raise interest rates sooner than many investors currently expect. What do you expect next from the Fed to calm nerves, if nothing else?
Yes, of course, that will be also the second thought markets will have over the coming hours. This report will boost interest rate hike expectations, and this is what we generally expect for the coming month, that volatility will increase because market participants will realize that we will not remain in this perfect world we have seen over the last couple of weeks. And of course there is the worry that the Fed rises the interest rates at some point, and that might have impact especially on equity markets. We agree that this is one of the major risks to equity markets especially. And here Yellen yesterday stated that they're less concerned about the financial market stability and will not react so much, take it into account in their reaction function. So this should actually increase investors' worries with regards to the Fed, that they will go ahead with their plan to normalize interest rates and withdraw liquidity going forward. And this will have an impact on equity markets and especially also, of course, on bond prices.
Now, because of tomorrow's holiday, the data coincided with the ECB meeting, who signalled no further drastic action for now at least. US Treasuries have jumped on the news, with the dollar strengthening against the euro up to $1.36. But what is your outlook for this pair moving forward?
We expect this trend to continue. So the difference between the central bank's policies in the US and in Europe will be the dominating theme, and here the Fed will move into focus now after the ECB actions in June. So we see this huge difference going forward, and this will also reflected in the exchange rate, especially as the Fed at some point will start to withdraw liquidity from the money markets into bank markets, and then as this relative monetary base, as you call it, so the relative liquidity between these two currency areas will change dramatically going forward. Euro-dollar is likely to decline towards 1.30, so our 12-month outlook stands now at 1.31.
Ulrike, thank you. Well, it may be a short week for some, but the TV team has plenty more to bring you, so please do keep clicking back. For all of those lucky enough to start the weekend early, have a great 4th of July.